about accounts receivables, okay? Accounts receivables is a balance sheet account, and let's remember a couple of things. Number one, why do we have accounts receivables? Because if you sell me something, and I always think about it as you and your company. If you sell me something, if I give you cash right now, then you will record the cash by doing what? Debiting cash and crediting revenue, right? But what if I don't have the cash to give it to you? Then you expect to receive that cash one day, so that expectation can't be recorded as cash. It can only be recorded as something that you expect to receive, which would be called an account receivable, okay? So, as you remember, on our balance sheet, we have assets, and we're just going to stop right here for right now. And on our assets, we know that we always talk about cash. We're going to really focus on accounts receivable today, okay? Accounts receivable. Now, how do we increase assets? We increase our assets with the what? With the debit. We agree on that, right? So if I have an increase in accounts receivables, then they're going to increase with the debit. Increase by debit. So anything that decreases it is going to be decreased using a what? A credit. So keep that in mind. Whenever accounts receivable goes down, both whenever and however it goes down, it's always going to be with a credit. So what's one way that accounts receivable goes down? I owe you money, right? So you increase your receivables, right? But once I pay that, will my receivables continue to increase on your account? It will decrease. How do I decrease it? With the what? With a credit, okay? Now, what about this right here? I'm good for my money, right? But if for some reason I walk outside and get hit by a Mack truck, that can happen, right? I mean, it's not likely, but it can happen. So you have to make allowances for that. I can just decide not to pay. I wouldn't do that to you, but I can just decide not to pay. You have to make allowances for everything that goes wrong, right? So when you record accounts receivables to this point, we've always said, this is accounts receivables. You're going to receive that no matter what, and you're always going to debit it, right? To show a receivable. We've always talked about, well, we just kind of talked about if you decrease it a little bit, it's going to be decreased with a credit. Now we're going to talk about another way to decrease it. So first let me write decrease with a credit, but we're also going to decrease with something we're going to call an allowance, okay? And that's just a short, but I'll talk about it in a second, with allowance. Now, what is an allowance that we're talking about? It is an allowance for a doubtful account. Now, it's doubtful in the fact that you might not get it. Like I said, I can get hit by a car, I could just not pay you. You have to make allowances for those things. And as we talk about later on, it may be a 1% chance, it may be a 2% chance, but whatever it is, it has to be made, you have to make an allowance for it with a different account, okay? So now, we've always had, and this is not going to change now, I'm going to do the journal entries over here, so that's just an overview, right? For accounts receivables, for a sale on credit, I'm going to debit accounts receivable for some amount, right? Now, this has always been, and this will always be, well, this is for the full amount, right? But there's also a way to decrease it, and that's by making the allowance. So how do I decrease it? When I see this right here, allowance for doubtful accounts, allowance for doubtful accounts, this is always going to decrease it by a certain amount, okay? It's going to be predetermined. The way we're going to do it is going to be predetermined. It may be 1%, it may be 2% or something like that. But it's always going to be given to you, or we're going to say 1% is going to decrease, 2% is going to decrease, or something like that, okay? So this account will always decrease accounts receivable. Now, this here is called an asset account, right? Since it's going to decrease it, it is going to be called something else. Anytime you're going against something, it is a contra something, okay? It is a contra asset account, or a contra account if you want to say it short, okay? So I'll write the full thing, contra asset account is right there, and this here is an asset account we're always thinking about, okay? Is everybody okay so far? All right. Now, let me go over here for a second. Can I reach that first section over there? Okay. We will not be preparing an entire balance sheet at this point. Excuse me. We will not be preparing a new balance sheet. But what I want us to know is something that we will know and that we will work on our homework is we want to know how this looks on the balance sheet, okay? Now, the style that I'm talking about, we won't be doing this now, but think back to the style that we had on the receivables, okay? On the retained earnings. We had retained earnings, add income, or less income if it was a loss, right? So the same feel is going to be here right now. You're going to have cash first. Then you're going to have your receivables. That's where we are today. Your receivables. Less allowance for doubtful, I'll abbreviate that, for doubtful accounts. Okay? Then you'll have your net receivables, okay? Or whatever that is, okay? So you'll have a certain amount here, then you will subtract this amount. This amount is going to be subtracted, and you will end up with a balance in there, okay? So anytime you have this, that's what we're going to have, okay? Now, whether you see it or not, let me put it this way. When you're looking at somebody else's financial statements, or if you are at your job, just looking at those financial statements, you may see receivables. Keep in mind now, you may know more than them about accounting. So what you may ask is, does this make allowances for, or does this include the impact of someone possibly not paying? What you're talking about is an allowance account, okay? So we have to make sure that we know that it's not just talking about what we're going to receive at this point in time. Now, we're taking into account that something may happen to someone else, okay? So we have our receivables, then we have, if we're doing a balance sheet, then we're going to indent a little bit and put less allowance for doubtful accounts. That bracket means to subtract it. And then we're going to have our net receivables, or whatever we have left over at that point in time, okay? Everybody okay with that so far? I'm sorry, nod your head if you okay with it? Okay. All right. Now, obviously we're going to have our revenue still over here. If we were doing a balance sheet, just to kind of show it with your equity, we will still have our revenues. We will still have some discounts. We don't want to have a lot of discounts, but we may still have discounts. So that account will still be working from last time. Less discounts, possibly less returns and allowances. So we're still going to have those, okay? So if there's a situation where someone returns something, we still would never debit the revenue to return it. We will debit either the sales discounts or sales return allowances. That's the one thing that we'll continue, okay? Everybody still good? All right. We're going to come back to this in a second, but I know sometimes you want to get started a little bit on your homework, so let's go over another quick concept. And it's still in the receivables category, but let's think of this thing called notes receivables, okay? What is a notes receivable? A notes receivable is a formal type of receivable, okay? So formal means it's going to be a little bit longer than our regular ones, all right? Now, notes receivables, before we talk about it, let's talk about anything. If I ask you for, how much money can you let me borrow today? Anybody let me borrow some money? What's the most you can let me borrow safe? That you're going to be okay? $2? $2,000?
No, $2.
$2, okay, all right? $2, right? Okay, now watch this though. $2, right? He could possibly take that $2 and invest in something like a stock goes up, or he could, whatever he wants to invest in, he could do something else at $2, right? So I don't care if it's $2 or $2,000. Whenever he is giving up his money, he has to get something in return. That would be interest, right? So anytime we're talking about interest is always a cost of money that is because someone else, you're giving it to someone else. You could have been doing something else. If there's nothing with keeping it, that makes him feel, if that's what he wants to do, he will feel a certain level of comfort that, he would give instead of not, he would have instead of not giving it to me. So interest is always the cost of money due to the passage of time. So interest for 1 day, I should pay him interest for 1 day, okay? I should pay him for 2 days. If you choose not to do it, that's fine. We usually see that under regular accounts receivables, usually, but we see it more so under notes receivables, okay? Now, there are going to be some examples of both, but I just want to make that point that interest is always due to the passage of time, okay? Now, usually we'll see, and I'm just going to throw out a number to make it easy for us, okay? If we see that something has, and let me erase this because I don't want us to think that this falls under assets, okay? This is talking about interest. Now, if we have interest, an interest rate, it may be quoted monthly, it may be quoted yearly. So let's always make sure that we understand what it is. We're just going to use 12% as a round number, as something easy, okay? So we're going to use 12%. Now, if I have an interest rate of 12%, if it is an annual interest rate, then what we're thinking is about 1% per month, okay? Approximately 1% per month, okay? That's what we're thinking. If the interest rate is quoted as you have an interest rate that is quoted as a monthly rate. Let's just say that we want to make that a monthly rate, then we would have 1% a month, okay? So it's maybe a little bit more that goes to it, but for the purpose of what we're doing right here, 1% will give you a 12% interest rate, okay? This is just a good round way to go about it because your homework is going to be structured in this manner, okay? So we'll usually see interest rates and we'll see them either yearly or annually, all right? Now, let me ask you a question. Today is, it's March to what? Let's say it's March, it doesn't matter. It's March. You borrow some money today, right? We agree? If I charge you a 12% interest rate, this is a what kind of rate for what we're talking about today? It's what? It's an annual rate. Should you pay 12% annual rate on something that you're only going to borrow from now to the end of the year? So always be careful. Even if it's an annual rate, then if it's borrowed in March, then you would have to basically say, well, that's 1%. So I only owe for March, April, May, June, July for 10 months, okay? So always pay attention to the period of time that it's over. Because if you don't, then you will pay too much if you're that person that has received with someone else. Or if I owe you something, you may not get enough, okay? So make sure that we always pay attention to when it happens. We're going to have that same concept with depreciation, okay? Depreciation is a cost that we'll add, and I'm just going to throw it out. We're not going to talk about it, but if you bought the machine this month, can you depreciate it over the entire year? You haven't had the entire year, right? So you only start as of the time, the date, or the month that's specified when you start, okay? So those are two concepts that we're going to talk about in this chapter. Everybody okay so far? Let's try to put it to use, okay? Let's see what we have here. We have a situation here where I have to go to the correct one that I want to go to. That's the situation we have. Okay. Now, these are homework problems, so let's always make sure that we're at the very least looking at these. But as we've seen, there's only really one or two ways you can ask a question. So by knowing these homework problems, we pretty much will know how to do anything else. Okay. So let's just do a problem here, and my numbers, of course, are going to be a little bit different, but the problem will be the same. So let's start by looking at exercise 8-1. Exercise 8-1, okay? Exercise 8-1. All right. In exercise 8-1, we're going to have a company, Oreo company, is going to sell on account. What does it mean on account? Does that mean they receive cash, or that means that they receive what? A promise to receive cash, which is accounts receivable. So that's a clear indicator that it's accounts receivable. On January 6th, the company sold merchandise on account to another company for this amount, $10,000, okay, $10,200. Now, what are the terms? What do the terms have to do with? We see 3%, we see 3/10, N/30. So remember that when we have 3/10 in this case, comma, N30, that's saying I get a 3% discount, 3% discount. This part here is if I pay in 10 days. The comma says otherwise, we pay the net or the full amount in 30 days, okay? Similar to what we did last time, just a quick review though, okay? So this right here, the sale is going to happen on January the 6th, and if they pay by 30 days, we'll make it approximately what? February the 6th. I know that we have those 28-month days and 31 days, but for the purpose of what we're doing pretty much in our textbook, we're going to always use 30-day months, okay? So it's for $10,200. We know we'll journalize in a second, but we know we're always going to record that sale for the entire amount. The entire amount is going to be done on credit. So let's go ahead and put that down, okay? Someone want to guess what that journal entry is going to be right fast? What's that journal entry going to be? We're going to debit what? You're not going to get cash, you're going to get it sold on account. So what does account mean? It's going to be an account's what? Receivable. There you go. Okay. So we're going to debit accounts receivable. We've already done this a lot of times. So accounts receivable for $10,200, and we're going to do our sales revenue for the same amount, okay? For the same amount. How does that look? Just like this right here. So that's what we have right here, debit the accounts receivable for that amount, and we're going to credit the other part, okay? Now, the terms, as we see this right here, but what happens on January 16th? January 16th, that's exactly 10 days, right? So what does that mean? It means the company gets a discount. The company's going to get how much discount? 3%, right? So they're going to get a 3% discount. So how much cash will we receive, okay? If you're supposed to pay $10,000, let me put it this way, remember it's always your company. If I was supposed to pay you $10,200, will I be paying you that amount? Nod your head. Will I be paying you less than that? Nod your head. Will I be paying you more than that? You're correct. I'll be paying less than that. So we already know, because I pay in 10 days, I'm going to put if, because I'm going to write this way, but we know it's because if I pay your company, and I'm stressing your company because we have to make sure that, remember that the journal entries are from your company side. If I pay your company in 10 days, you will receive less cash than the $10,200, okay? That's where we got that from right there. Now, even though we didn't debit cash, we know that this should be cash in a little bit, okay? So this 10,200 is what we're talking about right here. That's where I got that number from, okay? Everybody okay with that so far? So, we know it's gonna be a little bit less. How much less will it be? I take my 10,200, multiply it by 3%, that's gonna be my sales discount, okay? That's gonna be my sales discount. So, we can do this one of two ways. This is the way I like to do it, okay? I'll tell you the other way. The other way is just put your entries in and then work from the top to the bottom. That's fine, okay? But I always like, since I know, make sure that I read that right, they're going to pay the amount due, they're paying the full amount, then I know that whatever happens, I have to get rid of all of my accounts receivable. Does that make sense? They're paying it all off, right? So I have to remove this. If I say, let's just say this was due to, if it's due to me, okay? If it's due to me, then I want you to take everything I owe off, right? So I need to make sure that you take it all off by doing what? By debiting the accounts receivable for the total amount, okay? Now I'm going to skip to the bottom because I know what I'm going to do, but I'm just skipping to the bottom. This is going to be a credit, accounts receivable for me to you of 10,200. So whenever the full amount is paid, if it's paid before the discount period or after the discount period, we always take off the entire accounts receivable, okay? That's accounts receivables, and I just kind of made up a name as if I'm paying you. So that's accounts receivables, and that's the amount that it's for, okay? Now, we already said we're going to receive less cash, right? So think about it like this. This is all that we can take off the books. So this is the credit side. That's the credit side. And everything I do on the debit side must match up to that because my debits and credits must match, right? So let's see what we're going to do. If someone has their calculator, what is 3% of 10,200? $306. $6, okay? So $306. It's going to go somewhere. Doesn't really matter where. $306, excuse me. It's going to go somewhere in the debit column. Doesn't matter if it goes on the top or the bottom, but it's going to go somewhere over there, okay? So 10,200 minus $306 will leave me with how much, with the difference of what?
9,894.
9,894. If you happen to switch those two around, that's fine. Just want to make sure that we have everything that we need number-wise, okay? I like what y'all did on y'all test. If you didn't know the answer, you still went in and put in the numbers, so that's good. You know, don't ever leave anything blank, okay? So we know that right there. We got that part. Now it's just a matter of what account it goes to, right? So we know that this 98.94 represents what? I owed you $10,000. Let me be more specific. I owed you $10,200 cash. When you see this right here, that means that I gave you something to satisfy that. But it was within the discount period, so I only gave you this amount, right? So this represents what account? Cash, okay? This is your company's cash. I gave this to you. But I gave it to you because I owed it. So you now have cash of $9,894. What does this amount represent? Remember the 310? It represents what? If you don't know the count, just tell me what it represents right now. It represents the discount. And the discount is always related to the revenues, right? But we remember from the last time that we never debit revenues. Instead, we must debit something in place of that, which means that we will debit what account? Sales discount. There you go, okay? Good. Sales discount. For this $306. And just as a reminder, I'm going to just remind us that this is instead of revenue, okay? You don't have to write that part, but that's just a reminder that the reason we're using sales discount is because we never take revenue off once we record it, okay? Obviously, if there was an error, that's a different story, okay? But this is what we have here because you received cash of $98.94 because I paid in 10 days, okay? So you got a discount. This is that 3% discount that was taken off of revenues, and you have your accounts receivable for the entire amount. As a final check, we know that these add up to be 10,200, so I am correct in this case, okay? Everybody okay with that one? Okay. All right, let's continue on to another scenario here. This is going to kind of see how it looks here. Same thing there. That's 10,200 right there, okay? The next one I really want to do was this interest one, okay? I want to make sure that you have that because some of you may go ahead on your homework. So let me get you an interest account, okay? An interest problem. I'm going to leave that there. In this particular problem, we have a couple scenarios, okay? We have a couple different scenarios, and they're designed to help us to understand, what we're doing with computing interest. So that's why they have 3 different ones, okay? This helps us to understand how we compute our interest at different periods and for different reasons, all right? So, the instructions are simple. Compute interest and find the maturity date, okay? So, the first situation we have here is a note, and this is a notes receivable, okay? So, we talk about accounts receivables. So, notes receivables are just formal versions of accounts receivable, okay? So, notes receivables they are formal abbreviation accounts receivables. They are formal accounts receivables. Notes receivables usually have interest, okay? They usually have interest involved. Now, the interest is always over the period of time that we have. So, this first thing, when we talk about how much you owe, that is always the principal amount, okay? If you buy a house or a car, whatever you see that you're financing, that amount, that is your principal amount. The interest is always the cost of borrowing, okay? So, even though it's a notes receivable, I owe you. If it's a formal, then think about it. If I gave you the cash right now, you could have gone and done something else with that cash. You could have invested. You could have given your employees a better a bonus or something. You could have done a lot of things with it. So because I took a while to get it to you, you had to charge me interest, right? So the interest is always the cost of borrowing money, okay? So now, the first scenario we have here is on June 10th. June 10th. And we're going to have a principal, or someone's going to owe us, our business, because we talk about accounts receivable, someone is going to owe us $75,700, okay? $75,700 is what they owe us in our accounts receivable, okay? So accounts receivable, let's just always think, we have our assets, we have our cash, and we have our accounts receivable. This is where we are. Now, and by the way, notes receivables will be on this side as well with the assets. If we have $75,500, what does this 6% represent? That represents my interest rate of how much? For how long? For the entire year, right? It's for the entire year. So the total interest that will be paid here is going to be $75,500. If I multiply this by 6%, then this will give me the total interest for a year. And that's important, that is for a year. Keep in mind, that's for a year. Okay, so when I multiply that by 6%, what is that going to be? What will that amount be? $75,500 times 6% times 0.06 if you put it in your calculator.
4,530.
$4,530, okay? So, that's how much the interest is. Now, this is for the year, right? How long will this be out for? Will this be out for a whole year? It'll be out for what? 60 days. 2 months, if you want to look at it that way. Remember, for the purpose of what we're doing, we're looking at it as 30-day months, okay? So we're kind of throwing away the 28, 29 days and the 31 days, just 30 days. But remember, in real life, they don't get you for every day, even a leap year day, okay? So if I only want it for 2 months, if I want 2 months of interest, if I want 2 months interest, then you can either divide it by 12 and multiply it by 2, or you can just say I'm going to multiply it by 2 over 12. Whatever it is, if you divide it by 12, I think you'll probably see a lot clearer here. If I divide this amount by 12, meaning for the 12 months, then I will have how much? 4530 divided by 12 is going to be how much? What? How much?
You said divided by 12?
Yes, sir. 4530 divided by 12.
377.5.
377.5, okay? So this is for 1 month. Interest for 1 month. Then to get 2 months, all I do is take that and multiply it by 2. And when I multiply it by 2, then I will get my 2 months worth of interest. That amount would be how much? One more time? $755, okay? So my interest for that account there should be $755. That's how I came to this August 9th. Now, they're putting August 9th probably to the August 10th just to make sure that you understand it's within the 60 days. But this is 2 months worth of interest. So if you buy something that costs $75,000, if you have 6 months worth of interest and you're going to pay it back in 2 months, you're going to pay back $75,500 plus an additional $755. And that's only fair, okay? Now, think about it in terms of accounts receivables. You sold me something, okay? And you sold it with your credit card. You sold it to me, and I paid with my credit card to you. You have recorded an accounts receivable always for the full amount, okay? So you recorded the accounts receivable, right? But you also were going to have some interest that was involved. And we're going to talk about how to record the interest later, but I want you to understand how to compute the interest first and what it means at different times. Does this kind of start? We're going to do a couple more of those, but does this kind of help out a little bit? Nod your head, be okay so far? Okay. And we're going to do a couple more just to show the difference. Keep in mind, I'm just going to throw this out. We're not going to do this in this class, but we want to know that if this was December the 1st, and it was due 30 days later, which would have been January the 31st, that goes over the course of 2 years, right? So we would have to split that, because it's only 2 months, we would split that in half, and whatever is the interest that was earned from December the 1st through December the 31st, that would stay in that part of the year, in that year. All the other interest would go over here. That's going back to that matching principle and why we do accruals, okay? So we do accruals to record the effects of cash before the cash is ever exchanged hands, okay? So that's just an example of why we would use the accruals in that section, in that way, okay? So the next one here, July the 14th, we have principal or I am borrowing $49,600 from you. I'm borrowing that from you at a 7% interest rate this time for 90 days, okay? So let's look at this scenario. I'm going to keep that there because we're going to see that no matter what we do, it's going to pretty much be the same exercise, the same accounts there, the same process, okay? So that's the reason I'm going to leave that there. So this time we're going to borrow, is it 49,600? Is that okay? I'm going to borrow from your company $49,600, which makes you have an accounts receivable of $49,600, okay? Now let's go through the computations. $49,600. Now, how much is the interest rate? 7%. For the month, for the day, for the year, what's that for? For the year, okay? So, times 7% interest rate. Remember, this is your accounts receivable that I owe you, okay? I owe you that. So, at the end of 90 days, you're going to have a certain amount of money. First of all, what's $49,600? I'm sorry. What's $49,600 times 7%?
$3,472.
$3,472. So now, this amount is 7% interest on the principal that is borrowed in terms of you sold me something. So either you sold it to me, I'm still basically borrowing the money. Why? Because you come back and repossess it. And then you take the accounts receivables off the book that way, okay? So $49,600, 7% interest, $3,472. This is how much you will earn over 90 days. True or false? False, right? Because it's only a note for 90 days. So we know 90 days is 3 months. However you want to look at it, you can go on a day-to-day basis. You can go on a month-to-month, or you can go on a month basis. Let's just look at it a couple of different ways. Okay, so if I go on a daily basis, assuming that $360 is, assuming 360 days in a year, then I would divide it by 360 days. Okay, so someone can divide this by 360 days. Someone else can divide it by 12 months, okay? Whichever one you're more comfortable with is okay, but I want to show you that they come out to be the same answer. So we're going to divide this by, you give me the number for that one, and whichever one you give me, we're going to go with. If you want to go days, we've already done days. We've already done a month, so someone give me those there. Which one?
For 360.
Okay,
9.64.
9.64. That's $9.64 of interest per day. Okay, $9.64 interest per day. Now, how many days will be outstanding for? 90 days, right? So we will have our 90 times 90 days outstanding. Will give me how much interest at this point in time, at the end of that. $9.64 times 90 days will give us an interest of
867.6.
867.6 or 60 cents, okay? Now, if you just divide it by 12 and multiply it by 3 months, you will get how much? You can give if you want to give the intermediate steps to really see how it works, that's fine. But whichever one, some people are more comfortable with days, some people are more comfortable with years. This is more real life. This is for our homework. So whichever one is easier, because sometimes you have the leap year, right? And I say they count all days in real time. Okay, so this is the daily way to go about doing it. If I divide it by 12 months, what do I have?
289.33. 289.33.
Oh, let's see. 9. I'm sorry. One time.
289.
Oh, 289. Okay, 289.33.
33.
All right, and that's only for 3 months. So I multiply by 3 months, and what do I have?
868.
868. Only do the rounding, okay? Now, because we're doing the one usually with days, the one we're going to record here will be the 868 one, okay? Or one, because we're doing it with months, 30-day months. This is what we have here, okay? But we see that there's a slight difference if you round it up, which as you see here, we have no rounding in here, okay? We have no rounding, just full amount. it's still $868, okay? Make sure you can see that there, $868. $868. When you round it up, that's equal. So obviously, if this were real life, I feel more comfortable using this right here because I wouldn't miss anything, okay? But either way you go, it's not gonna let you put in decimal points, so we're still having $868, okay? So whichever one you're more comfortable with is just fine for this class. So this is how we go about computing interest in terms of interest that we receive based on discounts. Sometimes we talk about accounts receivables, or in this case here, we're just looking at just pure interest computations. And so whether you are the borrower or the lender, you will understand in terms of how much interest will be given or received depending on which side you're on, okay? Oh, yes, ma'am.
Whenever we do the division with the months, where it's 12 months divided, and then we get that solution,
Mm-hmm.
do we always divide it by 30? Because some months are 31 days, and others are.
Right. That's one of the assumptions that we make. Instead of calculating the 28 days or the 29 sometimes, or even the 31 days, the way the book does it is the book always says 30 days. Just for the book now, in real life, they're gonna go by every day, okay? So only for book, and I probably understand why the numbers are usually gonna be more round if you do that there. But for book purposes, in this book here, they're doing it based on 30-day periods, okay? Good question though. And once again, if this overlap the reporting period, we always talk about years, we're not talking about quarters. We're not talking about all that, but it overlaps the yearly reporting period. We're always going to make that adjustment at that point in time. Okay. Now, you feel okay with that so far? And we will do some of these on our exam. Okay. Let's go back and do some more journal entries, okay? All right. We're going to go back to the journal entries, and journal entries / balance sheet, okay? Because we're going to think about the balance sheet and income statement. We're not going to do one, okay? We're not going to do one this time, or going forward we won't do one, but we're going to talk about it, okay? How it relates. Okay, so let's go back for a second and let's think one more time about assets, liabilities, and equity, because we never, even though we're not going to prepare that income statement or the balance sheet, we always want to know where these fall, because as we just saw in the last chapter, everything is going to end up in one of these two places, or in one of these places, okay? Which makes our debits and credits easy. We increase equity with the credit. We're not worried about liabilities yet. And we increase our debits, our assets with the debit. So we have our cash. We talked about that. You already wrote that down. We have our accounts receivable. We already talked about the fact that you increase with the debit for cash. You increase with the credit, excuse me. You increase with the debit for accounts receivable as well. Then we talked about the fact that if you have to write off a portion of that account, that is going to be written off under allowance for doubtful accounts. And that is going to be, watch this, allowance for doubtful accounts is also going to increase with a credit. And I wrote that big because we have to understand what does increase and decrease mean. Increase and decrease is different than the effect that it has on something. So, assets, we increase any asset with a debt. Any asset. Anything that causes the asset to decrease is increased with the credit. So if it causes the asset to decrease, it's going to increase with the credit. Is everybody okay with that? So I'm going to say it again, but is everybody okay so far with that? If it is an asset, no matter what the asset is, you increase the asset with the credit. Anything that decreases an asset is going to increase with the credit. That'll be allowance for doubtful accounts. This also shows the link. Allowance for doubtful accounts is a balance sheet account. Accounts receivable is a balance sheet account. And allowance for doubtful accounts. Both are balance sheet accounts. Both are balance sheet accounts, okay? Now, it increases with the credit. We also have this thing called bad debt expense, and let's explain what's going on here. If it's your business and I owe you money, okay? If you have to write off a portion of that, you can do it one or two ways. It's January, or it's let's say it's near the end of the month, right? And everything that happens in March, we want everything that happens in March to stay in March. That makes sense, right? We had spring break in March, right? So imagine if it's your business. A lot of people bought a lot of stuff on spring break that they're not going to buy for Easter. Let's just say that you're going to have whatever makes it favorable to you, more or less. If you have a more favorable March, then you have a more favorable, if you have a more favorable March due to spring break, then you'll have a more favorable April due to Easter, then you want everything that happened in March to stay in March. And we do that with accruals. Now here's why I say that. I bought something from you this month. You have to make an income statement every month, right? The month you did good in, you want to, if you did good that month, when you start subtracting expenses, you will have more revenues to offset that expense, right? So let's just think of this right here. You're not going to know I'm not going to pay the next month. Next month is when you're going to find out I didn't pay, right? If you don't make allowance to keep it over here in last month, then it's going to hit this month, and we don't know what next month is going to be, okay? That's just one of the ways of looking at it. So that leads to two different concepts. You can either record bad debt expense when it happens next month, or you can make allowance for it before it happens, in the month that it happened, okay? If you do it when it happens, that's called the bad debt expense method. What we're focusing on is the allowance method, okay? Why? Because it allows us to keep things in the period of time that it happened. The allowance method allows us to keep it in the period of time which it happened, which means we have to guess sometimes, okay? You remember we just did a problem that said we had a 3% allowance, or no, we didn't. Let's just say we have it's a 5% chance I'm not going to pay, okay? You know that people that come in, overall, it's a 5% chance that they're not going to pay. It could be 2%, 1%, whatever your problem gives you, okay? Whatever it is, you made a guess that some percentage of sales is not collectible. When you get that percentage will go into an account called the allowance for doubtful accounts. And we're going to do the journal entry for doubtful accounts, but this is to make sure we understand what's going on behind it, okay? So, no matter what happens, when you start a business, you can if you don't know any better, that's okay. Do what I did. Go to some corporate financial statements and look and see what type of accounts they have. If they guess that 10% won't pay, who am I? I'm gonna guess that 10% is gonna pay. Not gonna pay. Now, as time goes, I may find a better way to collect than they did. Or I may have better clientele, or it could be worse. But if I don't know, your competitor's probably not gonna tell you. Just go to a publicly traded financial statements and see what their percentage is, okay? So that's gonna be guessed ahead of time. Now, every journal entry has two things in it, two journal entries, okay? And then every accrual has at least one income statement account and at least one balance sheet account. We've already determined that allowance for doubtful accounts is a balance sheet account, right? So since this is a type of accrual, there also has to be an income statement account. The income statement account will be called bad debt expense. Bad debt expense lowers equity. Bad debt expense reduces equity. Bad debt expense reduces equity. I'm going to write it in this way. Bad debt expense, when debited, it reduces equity and increases bad debt expense. Let me put that in blue. And I want to make sure we understand the difference because sometimes we may get caught up. So the effect is that it reduces equity. The journal entry, a debit, shows that it's going to increase bad debt expense, okay? Is everybody good on that part? Nod your head if you're okay so far. So, the accrual entry is going to have bad debt expense, and it's going to have allowance for doubtful accounts. Bad debt expense is a income statement account, obviously under equity. Allowance for doubtful accounts is a balance sheet account under assets, okay? The whole reason we do this is to make sure that we keep our bad debt expenses in the period that it originated from. What would it look like if I bought something for you, if I bought something from you in Christmas, during Christmas? That was last year, and you just found out I couldn't pay. Isn't it right for you to have your bad debt expense back then? If for no other reason, you could say that, well, look, I figured out that I can't sell as much because people keep returning, okay? So for a lot of different reasons, but for accounting purposes, we want to always match our revenues with our expenses. Bad debt expense is an expense that must be matched with what happened last year, okay? So it's March. I'm just now returning something. You will make a journal entry over here this month, but it's going to count against last year. It's going to count against last year because I've used the allowance for doubtful accounts method, okay? So, think Christmas. One more time. I bought it from you in Christmas, during Christmas. Everything that you thought, you made a guess that some percent of sales is not collectible. That way, whenever I do a journal entry over here, the next time when we do journal entries, all that's going to be done, but the impact is going to be over there, okay? So we do the allowance method to make sure that the impact of whatever we did goes in the period in which it actually originated. All right. When I debit bad debt expense, when debited, it reduces equity and it increases bad debt expense, okay? We will not have that multiple choice, but you want to understand the impact because any expense is going to lower your equity. Any expense. We can put any expense here, like we did last time. Remember, even though we're not doing closing entries, we talked about closing things by doing the opposite of that. If we increase our bad debt expense and decrease it, we would do something else with it, which would be the credit, okay? So all of this, please make sure we know this because this is the only thing that will probably get you kind of tripped up a little bit right here, okay? Everybody okay with that so far? All right. So let's go here. We only have time to give you the format, but then we'll go into it a little bit more with some problems next time, okay? And this will pretty much cover all of the chapter. Of course, we'll do some practice problems as well, okay? This is the general format that we'll have. For a sale on credit, we're going to debit accounts receivable. I'm going to put debits up here on this side. I'm going to try that again over here. We're going to debit accounts receivable, and we're going to credit revenues, okay? And I'm just going to put a number up here just to hold a place, okay? That's for a sale on credit. Okay. To record the estimated bad debt, to record the estimated bad debt in the period of sale, that is very important. To record the estimated. We don't know. We're guessing 2%, 5%, 1%, whatever the problem gives us. So estimated is very important. In the period of sale is even more important. Then we're going to debit bad debt expense, and we're going to credit allowance. A little better. We're going to credit allowance for, this is all one word, one phrase, doubtful accounts. Allowance for doubtful accounts, okay? We're just going to make up a number, doesn't really matter the number, but the format is what we will use, okay? Focus on that format. This is for the estimated amount in the period of sale. Please make sure we leave out this class that we know that's for the period of sale, okay? Now, that would be December, okay? Whenever we see customer, I'm going to put will not pay. It could be cannot, but will not pay. Whenever, this can be, obviously it's going to be a certain period of time it's going to run out, but next year sometime, whenever we see that happen, if you don't find out till May that I can't pay, you're going to have to make an adjustment, right? But you're going to take a part of the adjustment out of your allowance for doubtful accounts. Whenever we see the customer will not pay, then we will debit allowance for doubtful accounts, and we will credit the account receivable for whoever it belongs to, okay? So it may have been for $50. Like I say, we're not focusing on the dollars right now, but we're focusing on the process. So let's go back through. Whenever we make a sale on credit, we've been doing this, right? Debit accounts receivables, okay? And this is your company. I am buying it from you. So this is me buying it from you. Keep in mind, there's going to be a lot more people now. There's going to be a lot more customers, but I was just specifying one person at this time. For the entire group of people you sold it to, this is the total amount that you figure it's going to be. You estimate it. No matter what it's based on, you've estimated for every $1,000 you won't receive 100. You don't know if it's going to come from me. Now, I'm just one of many people. You don't know if it's going to come from me. This could be, we don't know how many people are going to sell to. We just know based on prior experience that for every $1,000 we sell, we will not collect 100. We just know that, okay, based on what we've done. The data shows us that. This is always done in the period of the sale, in December for Christmas. Let's stick to one holiday this time, for Christmas sales, okay, because that's on the other end, but it's so close to the end of the year that we can start to see why you have to do it in that period to make sure that everything stays over there expense-wise, okay? Now, whenever you see that I'm not going to pay anybody, then you don't go and take it out of last year's, but this account here, this account changes all the time. This is an income statement account, which allows the income to stay over there. This is allowance for doubtful accounts, and we will take it out of here. Now, this is not just related to me, but for the purpose of this right here, this is going to be due to me, and it's going to be there because of me, so we're going to associate this with me, and we're also going to associate part of it with me as well. So just say I'm your only customer, okay? So I've already shown that I'm not going to pay half of it. But this is the same exact account right here. That is the same account. Now, here's the other tricky part. And I say tricky because it's always 2 inches. You didn't know I wasn't going to pay. But in the event that I'm able to pay, you would think that, well, obviously we're going to debit the cash, right? Because I'm going to give you the cash. You could think that you're just going to debit the cash and then remove the receivables. But think about it. You've already removed the receivable related to me. So 2 entries. If a bad debt customer repays, there will always be 2 entries. There'll be 2 entries. One, you have to actually reestablish that I'm on the books. When you did this, you kicked me out of my system, right? You kicked me out of the system. So at this point in time, I volunteered to call you, but you don't have an account for me. So you have to put an account back on the books. So you must first reestablish the bad debt account. So number one, reestablish the bad, that stands for BD, bad debt account. Reestablish the bad debt account by putting it back on the books, accounts receivable. Okay? And then you also have to put that allowance back in there. See, you use up part of that right there. This changes every time. So you no longer have that. You have to reestablish that. What you wrote off, you have to put it back on the books. Okay? So accounts receivables. And you're going to reestablish the amount in the allowance account. That goes on the debit side. Sorry about that. The credit side. Reestablish the allowance account. And then you can record the payment, okay? Then you can record the payment by doing what? Debiting cash, and finally, for the last time, taking that accounts receivable off the books, okay? So the quick review. We've always talked about making a sale. This is what we've always been talking about. This sale was recorded during Christmas, during the time when it was there, okay? Debit accounts receivable, credit revenue. You also must estimate. It'd be very wise of you to estimate that somebody is not going to pay. How do we do that? By doing an accrual. At least one income statement account, bad debt expense. At least one balance sheet account, allowance for doubtful accounts. This is done in the period of sale. Whenever you see the customer will not pay, you don't go back and put a brand new bad debt expense in, because you remember last time how we closed out, zeroed out all of the expense accounts? That was zeroed out. So you don't want to go back and put something in new. Instead, you take it out of this allowance for doubtful accounts, $50. If for some reason the customer repays you later on. You can't just go record cash and do the receivables, even though essentially we've done that. We've debited the cash and put a receivable in. We can't just do that. We must reestablish the account and related allowance to fill it back up, and then we can record the amount of cash that we have, okay? And that's pretty much what we have. And we'll do some more examples next time. If you can, I ain't say commit this to memory, but if you can commit that to memory for your exam, you'll be okay on that. Everybody have a good day.